It's crazy how many companies these PayPal guys ended up getting involved with. Have you crossed paths with the PayPal guy companies, like in any material way throughout your life?
Yeah, I think that these guys are kind of stamped all over my life. One anecdote in particular that's slightly embarrassing for me is that I interviewed with Tesla when they were about a 500 person company back in 2010. And after a couple of rounds of interviews, I told them that I was going to go do a PhD and kind of wasn't interested. And then I decided not to do a PhD, called them back, and of course they had moved on. And so I missed out on the Tesla ride with Elon very early on, unfortunately.
Yikes! Yeah, I remember that. I remember that. Um, yeah, I think for me the main thing I think of is in eighth grade, I had a friend who was making several $1,000s a month, burning CDs and selling them on eBay. He had like a whole business on eBay as a 12-year-old.
Nice, nice.
All right, ready to do this?
Let's go.
What was at work also, of course, was market psychology. Once a bull market gets underway and you reach the point where everybody has made money no matter what system he or she followed, a crowd is attracted to the game that is responding not to interest rates and profits, but simply the fact that it seems a mistake to be out of stocks. In effect, these people superimpose and I can't miss the party factor on top of the fundamental factors that drive the market. Like Pavlov's dog, these investors learn when the bell rings, in this case, the one that opens the New York Stock Exchange at 9:30 in the morning, they get fed. Through this daily reinforcement, they become convinced that there is a God and that he wants them to get rich.
Well done. I feel like you need the Diet Coke next to you now.
Yep. So that was a Warren Buffett quote in Fortune magazine in 1999, where he's describing the FOMO psychology of the stock market bubble in the very late 90s, which is where we pick up for our final episode in the Tech and Telecom series. It's January 1999. The spidey sense of every smart investor is just flashing red at this point, like you heard in the Buffett intro. And that's because over the last 3 years, stock prices have more than doubled. You have all these brand new public companies that have no profits and arguably no useful products, but they're still trading in the billions of dollars on public stock markets. The Nasdaq, it's normally kind of 20 to 30 times earnings is the normal range. At this point, early 99, it's starting to push past 100. It's going to go all the way to 200, which is just completely nuts. And so, for a while, a lot of smart people were kind of worried about the crash. But at this point in early 99, they're talking about it openly in the newspapers and the news. And yet, in Silicon Valley, we find 3 mid-20s, late-20s founders who somehow still believe that it's a great time to go build a new world-changing company. So even though the news cycle is flashing danger and the smartest people in the world are giving great reasons for why the sky is about to fall, all of these guys see is a monetary system that hasn't caught up yet, right? They see the internet has affected really every other space, but the finance world is stuck in atoms, right? They're still seeing paper checks. There's still a bank branch on every corner. Everything else has moved online. And so these guys smell opportunity, where a lot of people would have hedged their bets and arguably should have kind of waited to do something. They didn't. They leaned into what at this point is, can be described as like a blazing fire, a fiery furnace that was about to consume everybody. And they somehow come out of this not just successful and alive, they come out of it refined into the best entrepreneurs and investors of their whole generation.
This is a story of a group of people that started a company and they were targeting a brutal market at arguably one of the worst possible times to start a company, right? Early 99, like you described, about a year before the dot-com bubble burst and capital markets shut down. And then somehow, these guys navigated from crisis to crisis to first an IPO and then a major acquisition by another public company, eBay. And then after that, this group went on to effectively create the foundation for every technology wave that came on after that. So it's a fascinating story, and I think one that has a ton of read-throughs to some of the things that we're seeing today in the markets.
Right. So something about this survival story turned this group into something extraordinary.
Yeah. By the way, Elon said, which I think is a great lead in to what the story is about, Elon said famously that PayPal was not a hard company to start, but it was a hard company to keep alive, which I think is a perfect description of the story.
Yeah, absolutely, absolutely. And so you've got these three founders who want to go for it, even though it's very late in the cycle. Arguably not a good time to do this. The first one is this guy Max Levchin. Max is born in Ukraine.
Do you know what his parents did?
Remind me.
They were physicists and computer scientists that worked in research community. And at some point, they lived near Chernobyl and they had to move. They moved to Crimea, of all places, because of the meltdown at Chernobyl, which
Yeah.
is fascinating. And then, of course, they come to the U.S.
Yep. And so Max, he doesn't show up on the scene at all in Silicon Valley until mid 1998, after he graduates from none other than the University of Illinois Urbana-Champaign, which
Illinois.
he did the same program as Mark Andreessen. During his undergrad, he definitely caught the software startup bug, but he didn't have any particularly big successes. I think he made just enough money to get himself to Silicon Valley. Basically, is my read of it.
Yeah, he was pretty broke, right?
Yep. And so in 1998, Max Levchin's 22 years old. He's totally broke. He's actually living couch to couch with friends, and he's just looking for another startup. He's caught the startup bug, and he's particularly interested in cryptography on the internet. Down the road, at the same time, there's this little-known lawyer turned hedge fund manager, a guy named Peter Thiel. And Peter's giving a free lecture on global currencies, which at this time, it's his favorite topic is how the internet revolution was going to collide with unstable monetary systems. That's like what Peter was obsessed with at the time.
A lot of depth.
Yep. Max Levchin had heard of Peter Thiel because Peter backed his friend Luke Nosik's company. So he goes to the talk. He kind of knows him. He's got no money, so the free lecture is interesting. It's summer, so he probably likes the air conditioning. And actually, only 6 people attend this event that Peter Thiel is talking at, which is hard to believe. But Max is impressed by Peter's talk. And afterward, Max walks up to Peter. You can kind of picture it, right? He's very young. He's a classic hacker in the time. So he's, super skinny, hasn't been sleeping because he's only on couches. He's probably wearing the same clothes he's wore, for the last week. And the story is that he notices that Peter is kind of stuck in an awkward conversation with one of the other people. And so Max decides to play the hero and kind of just break it up. And he just kind of butts in, presumably very awkwardly. And he says, hey, you funded my friend Luke Nosik's company. I'm working on encryption on Palm Pilots. And so whatever happened in that quick conversation is enough to get Peter to agree to meet Max the next morning for breakfast.
And Matt, Peter's an interesting character too, right? Because he was born in Germany. I think he moved around a lot. His dad was a mining engineer. And Peter is a guy that by this point, by the time he's giving that lecture, yes, he had gone to Stanford Law School and had gone through the traditional, very competitive path to get a great job and start a great career, which, he clerked for a judge in the U.S. Court of Appeals, which is the sort of circuit right underneath the Supreme Court. He had famously interviewed for a Supreme Court clerkship that he didn't get. And that was, I think, a pivotal point, as he at least claims in his life, where he realized that he was in this rat race of crazy competition. And that failure sort of woke him up a little bit. So he ends up working at that law firm, but he only lasted 7 months because he realized this is not what I want to do, which is how he ends up back in Silicon Valley founding that hedge fund.
Yeah, it is actually interesting to think about how before we meet Max and Peter in the story, they've already had failure in their lives, even though they're very young.
Right.
So they've already experienced failure. They've already sort of risen from the ashes to move forward. And I think that might be a big part of their makeup kind of heading into all this.
Totally. And I think it's also very clear that these are very, very smart people.
Right.
I mean, Max was programming apparently when he was a kid because he didn't have access to a computer in Ukraine, was programming with pen and paper. Right. So that whenever he would get access to a computer, he could just feed in the program and see if it would run. So these are both like incredibly high horsepower individuals that are colliding.
Right. And so they're colliding over smoothies. And so within weeks of this smoothie breakfast, they incorporate a company around this Palm Pilot encryption idea. They call it FieldLink. And Peter Thiel essentially leads FieldLink's pre-seed round. He puts in about $250K of their $500K pre-seed round. Actually, about a month or two later, Peter joins Max as the CEO of FieldLink. And by this time, the ideas have crystallized a little bit more with Peter in the mix about it, encryption for money on handhelds, beaming money back and forth from handhelds. So the first step in all this is to revolutionize money. On the other side of Palo Alto, at the same time, we find another founder who somehow thinks now is a good time to start a company. This particular founder is actually starting round 2 of their dot-com era, so they already had a successful company. That's how far along we are into this. People are starting their second businesses in the same wave. And, we're talking about a company called X.com. It's not the new Twitter, but it is run by the same guy. This is Elon Musk. And so everybody knows Elon Musk. He's born in South Africa. He went to UPenn, where he studied physics and finance. There were two things I learned about Elon that I didn't know before in terms of, like, how Elon became Elon that I think are interesting. One is I love that he interned at Scotiabank
Yeah.
in between his junior and senior year. Um, it's just so normal.
It's the most conventional thing about Elon's career path,
Yeah.
I think.
And so, the story is this is where he learned that banks are not innovative. But I just find it hilarious that, like, if you're listening to this right now and you're an intern at Scotiabank, hard coding numbers into an Excel sheet, you too might be the next Elon Musk.
Although Matt, to be fair, on the unconventional path concept, Elon apparently during that internship, didn't he pitch to his MD or somebody very senior at the bank that they should be buying more debt? Like there was some sort of element of a debt offering that everybody was running away, and it was priced really low. And Elon sort of looks at the fundamentals and suggests that, you know what we should be doing, not selling this or even holding it. We should actually be buying everybody else's book, because there's no way this isn't mispriced and isn't going to appreciate. And of course, everybody balks and the risk managers of the bank are like, of course not. We're not going to buy more of this debt that we're already getting crucified over. And he ended up being right. I mean, they don't buy it, but that did come back in price, and the bank would have made a significant amount of money. I don't know about the risk adjusted return on it, but they would have made money.
Yeah, my understanding is his view was that it was a risk-free way to make money, but that it was they didn't want to deal with the customer blowback of
Yeah.
taking that kind of risk at that time. And so that's where Elon learns that, like, man, these banks are kind of stuck in the mud.
Right. They're not doing the right thing, the rational economic thing. They do the thing that is sort of perceived to be the safe thing.
Not only does he intern at Scotiabank during college, but after undergrad at UPenn, his original decision was to do more school, right? Which is like one of the less risk-seeking things you can do after undergrad. He was accepted into a physics and material science PhD program at Stanford, where he would have studied energy storage. But this is where some kind of switch flipped in Elon's mind. He stays in the program for 2 days before quitting, and it's 1995. This is like right when things were starting. Netscape's just going public, so he's like, I gotta join this gold rush. Probably a little bit of regret minimization framework thinking, like Jeff Bezos.
Yeah, it's exactly. I mean, I think the question that I came across that Elon asked himself that reminded me of Jeff Bezos was that he was thinking, what is the thing that I can go do that will most impact humanity? Something along those lines. And I think he very quickly realized that if I go get a PhD, yeah, I'm going to be an expert in this stuff and I'm going to be able to work on it, but I'm not going to have the capital to actually finance it. And I'm not going to have the credibility to run with it and be able to get people to join me in it. And so he realizes that the first step in his sort of quest for benevolent power to push humanity forward is to amass wealth. And the best way to do that is to go start an internet company at the very beginning of this new technology wave. Very, very shrewd and very smart to have realized that, I think.
Yep. And so Elon and his brother Kimball actually start a company called Zip2. Zip2 is a software company that provides online business directories, maps, and guides for newspapers. And they're very successful with Zip2. They sell it to Compaq in February 1999 for $340 million.
Houston, baby.
That's right. And Elon himself makes $22 million out of this in cash.
Not too bad.
And so, here we are, even later into the tech bubble, from when FieldLink was founded. Elon's 28 years old, but Elon's sort of famously restless, right? And he doesn't see money in the bank to retire on or anything, right? All he sees is another inefficiency begging for a solution. The same thing that Peter Thiel sees, which is, money itself, fixing the financial system, modernizing it. And this time he can fund it on his own. And so Musk founds X.com with $12 million of his own money, right? So this is over 50% of his net worth at the time, because he didn't have any net worth before the Zip2 sale. Famously, he also spent $1 million at this time buying one of 64 McLaren F1 cars that he later crashes. And so X.com's goal, it's in the same kind of area as where Confinity ended up landing, but their goal is to be a one-stop shop for everything finance. So basically, he wants to kill Scotiabank and all the Scotiabanks.
digital bank of the future, right? Is
Right.
basically what he's trying to build.
Yep.
Checking account, a retirement account, everything that you do today in a digital way, banking wise, you would do with X.
Yep.
Which, by the way, when he bought Twitter, he pitched that he was going to turn Twitter into that. It hasn't happened yet, but I guess it still could.
And so we're in early '99. The Nasdaq's up 110% since the Netscape IPO kicked off this whole thing. Pretty much every smart, mature person is saying the sky's about to fall, and so consolidate, protect yourself for whatever's next after the sky falls. But these guys are just plowing ahead, starting super risky companies in the finance space. And you kind of have to pause and ask, like, what are these guys thinking at this point in the cycle, right? Aren't they already dead before they even get started with the NASDAQ at 100x and going to 200x?
Well, I mean, I think it's a combination of things, right? I think it's probably a little easier for Elon because he knew he was going to be doing this for the rest of his life, just continuing to double down. That is what he's going to do with his life. And he sees this as a great opportunity. He feels like he has an edge and he understands it. And now he has some capital and credibility. Let's go, tackle this obvious problem, right? I think for Peter and for Max is a little different because for them, they are primed to go start a company. I don't think they are sitting around worrying that maybe this is too late in the cycle and we shouldn't do this. Like Max for sure is going to start a company no matter what. That's what he's been doing throughout his whole undergrad. That's what he is in Silicon Valley to do. And so he was going to start a company, damn the torpedoes. And then for Peter, he has thought very deeply about currency and money. And so for him, this becomes, can we do something in money that is really big and bold and to some extent contrarian and start a company around it? And I also don't think that he's particularly worried about the cycle at this point.
Yeah, I think that's a lot of what I was thinking. I think it's also important to try to put yourself into the shoes of the time, right? So we're in the late '90s, and you can see something. You can see this in the data, right? Like consumer confidence at this point is it's higher than it's ever been ever in history. It's the highest it's ever going to be since then, and that's all because there was this ethos of the end of history because the Soviet Union had fallen and democracy and capitalism had won, and it was going to be the final system of governance to ever happen. And so you had this sentiment of permanent victory on top of the verbiage around there being a new economy. And again, you could see this in the data. From 1996 to 2000, you had GDP levels that were in the mid fours, and inflation's only at 2.5%, right? So you have like emerging market almost like style growth at low to moderate inflation, which at this point in sort of economic thinking, people didn't think that that was even possible, that you could have this level of growth and have inflation be low. And the source of this new economy thinking was real productivity stats, right? So for the first time since really the 60s, you had productivity stats that suggested that something new was happening here, something big was happening here. And so it's almost like whatever history people had in their mind was not relevant anymore because we're in a whole new world. America has won and we're sort of newly productive. And then I think another big factor was, at the time the market's super high. If you think back to kind of the last 20 or so years, kind of all the way maybe back to the early 80s, the market crashed in 87, but it recovered fast. There was a bear market after the Gulf War, but that didn't really matter. The market crashed when long-term capital management and the Russian currency crisis happened, but it recovered fast. And so the idea that we're going to go into this like very prolonged crash that's going to crush everybody is just probably not on people's minds as well when you think about that.
No, that's a great point. I mean, I think the economy's super resilient. Everybody trusts Alan Greenspan at the Fed because he's navigated all these issues masterfully. And then people are becoming more productive because of some of the technology that's coming into play.
And there's always the simple fact that these guys are all around 30 years old. They're all single, no kids.
Yeah, what do you have to lose?
Yeah, they're getting paid. They're working with people they like. So there's this in an optimistic time period. It's you could see it. You could see it. But the reality is that the market it's about to crash. And any new startup, you could make an argument that any company starting at this particular point is just already dead in the water. But during this time period, FieldLink plows forward. They raise $4.5 million from Nokia Ventures. They changed their name to Confinity, and they added email-based payments, so that not you didn't need a bunch of people with Palm Pilots to do anything with their technology.
And Matt, at that point, email payments for them was a sideshow, right? It was something that they kind of stumbled upon. They didn't even think it was a main product. They were just kind of doing it. But the main product at this point is still beaming money, from Palm Pilot to Palm Pilot, right?
Right. Right. Yeah. I think one of my favorite facts about this time is that Confinity hired Scotty from Star Trek as their spokesperson.
Yeah, and
He was
didn't
a
it bomb?
yeah, yeah, he was terrible. Apparently, he was like super old and didn't
Yeah.
know anything about technology. But good thought. Beam me up, Scotty.
Beam me up.
And at this time, Confinity starts getting just cold inbounds from eBay sellers asking if they could put a PayPal link in their auction listings, just kind of unexpected out of nowhere. And so Confinity responds to these unexpected inbounds. They run a couple tests, and they notice that they have a very dense node of early adopters among eBay power sellers. And so, in early 2000, they have a lot of conviction here. They actually pivot to be 100% focused on peer-to-peer payments on eBay. That's all they're going to do. They're going to be the best at that. And in early 2000, they raise kind of a real round, 23 million bucks from Idea Labs and Goldman Sachs.
Matt, there's a great anecdote around this, which is Luke Nosek standing in front of a whiteboard, basically showing the team why he thinks, eBay is the right target market for early adopters of this new sort of email-based payment system. And he draws a bunch of dots that are really far away from each other, right? It's a network, it's not dense at all, and it's really hard to connect these nodes in the network so that they interact with each other via payments. And then he draws a really tight knit group of nodes or dots, and he says, this is eBay. These are our buyers and sellers. The reason why this is a lot easier is because these guys have an underlying motivation to transact with each other because of the auction that they're participating in. This is a much higher density market, and it'll be much easier for us to grow trying to connect these people to each other, which is pretty fascinating because, it's intuitive, right? If you think about the way that eBay payments worked before this, if you're a seller on eBay, you basically had to put your item for sale. When the auction ended, the buyer, whoever won the bid, would have to send you a check or a money order via mail. So it would take about a week to get to you. Then you had to go cash it, validate that it was legit. Then you had to send the package to the person that bought the item. So all in all, it could take a week, it could take 2 weeks for the whole transaction to actually take place. Incredibly slow and painful versus this new email-based PayPal system where you could literally settle within minutes of the auction ending. So huge pain point and a market that is ready for this. And nobody else is solving this problem. Certainly not eBay.
There's a couple points in the PayPal history that I would have loved to have been a fly on the wall just to hear the conversation. Like I would have loved to have been at that Luke Nosek conversation, drawing the nodes and kind of arriving at this conclusion. At this point in the story, Infinity has one main competitor, and it's X.com. They're building a portal for everything finance, and that included email-based payments. And around this sort of huge vision, which, by the way, at the same time, Jim Clark is pursuing something not that far from this. So around this huge idea and the successful founder and Elon, they raised a $25 million round led by Sequoia, a tier 1 fund, and Michael Moritz, the famous venture capitalist who plays a big role in the rest of the story, joins the board. I think it's important that at this point, X.com they're not laser focused on eBay by any means, right? They're trying to be a one-stop. They want you having your savings account, buying mutual funds, taking loans, making payments, all inside of X. And eBay was just kind of in the mix, and so they weren't 100% focused on it.
Do you know why they get into payments?
In the story that they shared a common space with the Confinity guys, and they kind of just heard about.
So their offices were like on opposite sides of the same building. And apparently somebody from X may have overheard or somehow got word that PayPal/Confinity had been pursuing this eBay market and they were getting a lot of traction. And so they, Elon being Elon and being very aggressive and shrewd, realizes this is a great growth vector. And so they hop on to that market and they start competing pretty fiercely.
Right. And so here we are at the end of the tech bubble, and Confinity and X are just going head to head, feature for feature, head to head. And they're spending a ton of money to acquire the most peer-to-peer payments customers. And at this point in the cycle, they're focused on one thing. They're trying to take market leadership. One of these companies is trying to become the market leader. This is causing a huge cash burn issue for both companies that have no revenue model at the moment. They're actually paying users to come on. Confinity is paying $10 per user and $10 per referral. X is paying $20 per user and $10 per referral. In addition to these, what are effectively like marketing costs, they're also just eating credit card fees, and there's a lot of fraud, a ton of fraud at this point.
It's amazing to think that that sounds like you're just giving money away, but the reality is that you're basically very directly funding your customer acquisition costs, right? You're sort of, instead of just funding some sort of marketing campaign to try to acquire customers, what you're actually doing is saying, hey, customer, if you just basically come to me as a user, I will pay you. You're cutting out the intermediary in your customer acquisition and just going direct to the customer and basically paying them to become your customer, right? Paying them to go find more customers for you.
I think it's easy to bash this strategy as kind of fake, but my understanding is that there was a lot of analysis behind it, and they were paying more to acquire customers in other channels. They were paying, much higher than 10 and $20 per user to acquire customers in other channels. And so this was actually an economic decision to just pay users directly to come on. But the model is terrible. And at
Yeah.
this point, the business model is awful because costs are just increasing with volume with no offsetting revenue in sight.
You have viral growth, but your unit economics are
Right.
negative.
And it's all for market leadership, with the idea that only one person can be the market leader, which really means that the other player probably has to die. And so they're
Yeah.
trying to kill each other. At the same time, peer-to-peer payments had gotten a lot more competitive. And so you had a bunch of other competitors in the space. Yahoo had its own payments company. eBay had its own payments company. There were a couple other independents. And so at this point in the story, really just within a year of these companies being founded, they have about 6 months of cash runway. They have no plans to earn revenue. And now it's all of a sudden a very competitive playing field with a number of players. And so you're at another point in the PayPal story where it would have been easy to give up, right? And
Yeah.
say, guys, the market's starting to crack. This space has gotten really competitive. We only have 6 months of cash runway. Let's just get everybody paid for the next couple months and sell it or whatever. Instead, Max, Peter, and Elon, they keep the faith in the bigger mission that they're pursuing, and they merge. And so in March 2000, X.com and Confinity decided to do a 50-50 merger, basically to stop the bleeding. Coincident with this merger is $100 million venture financing, which is a big round even today. But back then, this is very, very much a mega round. And it's because, the VCs are now funding the obvious peer-to-peer payments winner. The alleged valuation was $500 million pre-money. And so there are two things about this merger that are really kind of startling. The first one is just the timing of it. This $100 million round happens at the end of March. February 2nd of 2000 is really the date when the Federal Reserve started hiking rates and started kind of basically taking the air out of the bubble. And the NASDAQ peaks in early March 2000, and it proceeded to fall like about over 30% between March, April, and May.
Yeah, it's the start of the dot-com crash, right?
Right. And so we're into the dot-com, the early parts of the dot-com crash. And the legend here is that, Peter Thiel, most entrepreneurs are not cognizant of the macro situation, right? They're focused on their product and getting into market.
Yeah, and most entrepreneurs are not Peter Thiel.
Right. Because you have Peter Thiel in the mix, he knows that the market is cracking. He's kind of been talking about it for a while. And so he's frantic trying to get this $100 million round into the bank, right?
Yeah, to fund, right?
Yeah. Before investors can get too skittish and come up with some reason to not send all the money. And miraculously, he gets all $100 million into the PayPal bank account, which is just absolutely critical to their survival going forward, because this combined company is now burning $20 million per quarter with no revenue model.
Yeah.
And so Peter Thiel really is kind of he played the hero role in this part of the story.
Yeah, totally. In addition to that, do you know what Peter did after they get all these funds into their bank account? This is, to me, the most memorable part of this whole story. He shows up to the board meeting after they close and fund the $100 million round, and he basically tells the board that he wants to take the $100 million and short the market through his hedge fund in order to make money from it, which is like the most bold move that you could do. You're walking into a boardroom and saying, hey, that $100 million that we just got in order to survive, and it's really part of our treasury to fund the company. I have so much conviction that that we haven't seen the end of this market crash. It's just the beginning, that I think we should short the market and make a ton of money and not have to finance any more of the company. Like, we don't have to raise any more rounds. Of course, the board balks, right? Mike Moritz probably almost had a heart attack, and they're like, absolutely not. Like, we cannot do that. This is not what we said we would do when we raised this round. And, from a governance perspective, You certainly can't do that, and you're going to get sued. But you do have maybe hindsight biased interviews with some of the people on the board that say he wasn't wrong. Had they done that, they probably actually would have made more money than they did with the actual sale to eBay, which is pretty wild to think about.
Yeah, it's interesting to think about how much that was on his mind as he was trying to get the money into his account. It's kind of like
Yeah.
the more money we can get into our account, the more we can short. But like, I would love to know what number board meeting this was post merger, right? Like I
Yeah.
can only imagine. Sequoia shows up for their first official board meeting, and Peter Thiel's got this presentation about how he didn't. And it wasn't that he wanted PayPal to short the market. He wanted PayPal to send the money to his hedge fund
Yes.
to short the market. And so, in addition to the market timing of this round, which is phenomenal, there's also a lot of drama around a merger like this. Elon Musk thinks there's no way that Confinity should own 50% of the resulting company, and it's actually kind of easy to see why at this point. One, their ambition is much bigger, right? The market size they're pursuing is kind of obviously 10x, 10x bigger at this time. They had Sequoia on the team, right? They had a tier one venture fund on their cap table and on their board to kind of back them as needed. And probably the key one in my mind, the real differentiators, they had just a much more reputable management team. Not only was Elon had a successful exit in his track record, but they had this guy named Bill Harris as the CEO of the company. Bill had been the CEO of Intuit, which is a public company with a multi-billion-dollar market cap just before this, and he took their share, he 3x'd their share price. So he's a successful public company CEO in the fintech space. Compared to Peter Thiel, who's about 15 years younger than Bill Harris, like there's really no competition in who had the better management team to take a company public, right? Which was definitely on their minds at the time. But it's interesting because the drama is that this guy Bill Harris is actually the one who forces Elon to do the 50-50 merger. There's a story about how Bill Harris basically tells Elon, like, Elon, if you don't take this 50-50 deal, then I quit and I'm
Yeah.
out, because there's no future for either of these companies unless we combine forces and stop spending each other into oblivion.
One of the things that was really interesting to me is looking back at this period, it's clear that Peter and Max, and to some extent Elon, all understand the network effects that will come from them being the market leader in this market, right? The moment that you start adding more, let's say, buyers and sellers on eBay to the PayPal platform, the more valuable it becomes for everybody else, because now there are more buyers and sellers that are using the same payments platform to, support these transactions. And so whatever platform ends up becoming dominant on eBay will have the strength and the capital to go tackle other markets and probably become the payments platform for the whole internet. And so they're very aware of this. Bill Harris, having run into it, is also very aware of this. And they realize that they're both going to compete each other to death. And if they just merge, then they can maximize the probability that the combined entity will be the market leader in payments on eBay, and therefore will accrue the benefits of the network effects that are inherent in this winner take most market.
Yeah, and I think you saw this in the valuation step up after the merger, right? Both companies were probably at about $100 million post merger from the rounds that had just happened, and then they raised $100 million at $600 million post money.
Right.
So you saw the effect of the network effects and valuation. So there was so Bill Harris is, he's forcing Elon's hand in the merger, kind of citing the negative of, like, we can't keep spending this much money, we got to figure this out. But this positive of, if we combine, we're the clear leader due to network effects, is also a big factor. But he really forced Elon into it.
Yes.
Elon didn't want to do it, but he had to at this point, right? If your new CEO is saying, I'm gonna walk out the door if you don't do this, then there wasn't really much of a choice for Elon at that point.
Yeah. And Elon is not particularly grateful. I think, I'm not sure that he holds a grudge, but he's definitely going to remember this, despite
Right.
the fact that I think Bill Harris was critical in the PayPal story in making this deal happen, without which probably we wouldn't have the PayPal story.
Right. And so the merger's done. They got $100 million in the bank, and Peter, Elon, and Max now have another survival issue on their hands, because the combined company is just smoking their cash, right? They're burning $20 million a quarter, and there's still no revenue for the company, really. Cash straight out the door in a model where costs go up as volume goes up. And at this point, the capital markets have dried up for the first time really since about 95. And so they need a business model to survive. So they had one. The business model they had is actually quite innovative at the time. They had one of the first freemium models, where they say if you're a business account, if you're a business transacting using this technology, then you need to upgrade to a paying account, and the model is 2.2% of transactions and 30 cents per transaction. This is another example. I would love to have been a fly on the wall for the new Luke Nosek kind of node conversation. I would have loved to have been a part of the development of this business model,
Mm.
right? Because it's a novel freemium model. It's pretty close to what they're still using for all transactions. And so they again come to this spot where they have to make these dramatic changes to survive and to win. They add a business model. About 25% of their users convert to business accounts. So they're into kind of real revenue, and they start cutting costs. They do some hard things. They cut out the referral bonuses. They have a bunch of innovations around security that lower fraud a lot, and they cut about a third of the staff. And so as a result, losses dropped from $20 million a quarter to sub $10 million of burn per quarter in the mid 2001 range. And from there, revenue growth is really going to take them to a free cash flow neutral and free cash flow positive by early 2002.
The fraud stuff is probably worth pausing on because PayPal is responsible for a lot of technological development that they probably don't get as much credit as they should in the mainstream. And Max in particular was pretty critical in this. And it all came about in these battles of fighting fraud and trying to reduce the cash burn from fraud. And also the realization that they can't be a payments platform unless they fix that. And things like CAPTCHA, which we all love to hate, when you have to like prove that you're a human when you're logging into something, that they developed that system. Micro deposit verification, which is whenever a bank or some sort of financial party deposits like a cent into your account in order to confirm that you are who you say you are and that is the right bank account. They invented that. And then human in the loop systems. So basically, for edge cases, you'd have some automation plus some human that's going in and labeling things and sort of manually, taking care of whatever task. And then you use those manual labels in order to train automated systems. PayPal came up with that. And so there's a lot of technical innovation that came out of that team.
One of the stories about the microtransactions for bank verification, just to give you a sense of like how people were on the internet at the time, there's the story that they would send 1 to 5 cents in two different transactions to your account, so you could prove that you were in the account.
Yes.
Apparently, people were mailing that
Yeah,
money.
they were mailing it back. That's so good.
which is cool.
So honest.
But there's a really kind of nuanced point about the market timing of all this that I think is super important to the story. At this point, they're switching from a market leadership focus to building a real business that's working towards profitability. They're showing a very keen adeptness to market conditions that a lot of entrepreneurs don't have. There's something really important about this kind of early 2001 time period. That's that prior to September 11th, 2001, the market downturn was very mild, right? And so technology stocks had gotten clobbered, but like technology stocks had no earnings, like weren't spending much capex. Like the average person was not affected.
The way I think about this, like when I look at the chart of the Nasdaq during this time period, and I look at the chart, I superimpose the chart of the S&P 500, you can barely see, a major movement outside of a traditional market movement in the S&P 500 during 2000, versus the Nasdaq really collapsed. But then when you look at the economic indicators and then you superimpose them on top of these two charts, the Nasdaq really didn't have a major effect in the mainstream economy. And the S&P 500 kind of reflected that. Things were generally fine until 2001.
Yeah. So at this up to 9/11 in the down market here, the first leg of it, unemployment went from 4 to 4.9%. So there is weakness, but it's not that bad. The S&P is not down much, like you said. But prior to 9/11, even though there was an economic recession declared in March 2001, GDP before 9/11 actually never went negative. And so at this point in the story, they have a business model. They're heading towards profitability, but the bear market is very mild at this point. This is just normal business cycle stuff. It's at this point, honestly, it's even like better than normal in terms of a down market. But then 9/11 happened. September 11th, 2001 was a major change in the trajectory for the real economy at this time. The internet bubble bursting in early 2000 didn't really affect anybody in any major way. Prior to 9/11, the S&P was barely into bear market territory. The Nasdaq's down a ton. The technology stocks are down a ton. But those are companies with no earnings. Those are companies with no debt. Traditional investors like pension funds or banks are not involved at all. It's really only VCs. Internet companies are not spending a ton of capex to where, it's going to have a big knock-on effect to other parts of the world. And so it really wasn't until after 9/11 that things started to get noticeably worse than normal when you think about like a market downturn and what a normal business cycle looks like. In 2002, the market was really bad. The S&P was down 28% that year. The Nasdaq was down another 47%. And that's because this is when the telecom side of the story comes into play. Part of the reason the S&P did okay up to now was that telecom was doing fine, right? And so the telecom bust really hits in 2002. They massively overbuilt. And so what you see here in terms of the economy is you start to see an actual credit issue, right? There had not been a credit issue with just the internet companies because there was not much credit tied up in that space. And it was the credit issue that started to, now you start to get bankruptcies. Now the tide is really rolling out and you're sort of seeing what's there. And now you get the accounting scandal.
There's a bit of an element of connection, right? Because they're not completely independent. Obviously, if the dot-com companies go down, and a lot of them ended up filing for bankruptcy because they ran out of time and they ran out of funding, of course, this narrative that we talked about in part 2 with, John Malone and Bernie Ebbers, like the people in the telecom side, the narrative that they had built up is that the internet wave was massive and there was going to be all this internet traffic and they needed to build for it. And WorldCom was certainly built around that narrative because remember that stat of internet traffic doubling, every 90 days. And so without that traffic materializing, and now that's obvious because all these companies are going away, and notably people are going into this trough of disillusionment where maybe the vision of the internet was wrong. Maybe the internet isn't going to change everything. I think that certainly starts to get into people's minds as the optimism that you described earlier goes away because of 9/11, right? So 9/11 happens, all this optimism of post-Soviet Union collapsing, end of history, et cetera, starts to go away and get replaced by this like shock that this horrible event happened. And dot-com companies are going away. So there's less demand for the telecom side and all this infrastructure that they built out. And now everybody's questioning whether the CapEx is actually going to have a return. Some of the same questions people are asking today about AI. And now credit crunch.
Yep. And and as a result, unemployment starts to go towards 6%, which affects consumer demand. And so I think there's really this second bear market here. You had a first bear market up to 9/11 that was normal, and there's really a whole second one that's caused. And the first one was just caused by rising interest rates.
Right.
The second one is more caused by the shock of 9/11. It's worth commenting, like even though the real economy got bad, banks actually were fine. And so while so it was actually mostly the high yield market, right? Remember we talked about how telecom became about 30% of the high yield market,
Right.
and so it's mostly the liquid debt market that is taking the brunt. Actually, when you look at high yield default rates, they almost touched 10% at the peak of this time period, which is about where they were in the Great Financial Crisis, and those are the kind of two highest points.
That's bad.
Yeah. And so you had the telecom debt busts from the high yield market, you had the accounting scandals, and you had a CapEx recession.
Yeah.
But I think it's, just as we go through all these cycles and try to strip out learnings, I think it's super important to say that the banks were okay. Post 9/11, you got real problems with the real economy. Any early stage company is super fragile. You're at another point where, as an early stage company, you're looking at your coworkers and you're being like, "What should we do here? This seems tough." And so what does PayPal do? They've got a business model now. They've got a path to profitability. They are one of the best known consumer brands on the internet. I read something about how the only better consumer known company on the internet was Napster,
Yeah.
actually. Um,
Great company.
yeah. And so instead of cowering in the corner in the shadow of 9/11 or hunkering down amidst all this uncertainty, like another big thing is, are we about to go to war? Right? People don't know.
Yep.
What does PayPal do? Of course, they file for their IPO.
Yeah, which is also notable. I mean, this is Peter Thiel written all over it, right? Because September 2001 is, I think, the first month in a couple of decades up to that point since there was no IPO in a given month in the US stock market. And so Peter goes back and thinks, if nobody's doing it, maybe that's exactly what we should do.
Exactly. So they file for their IPO at the end of September 2001. So they were already working on it before 9/11 happened, but the decision to go forward with it is a pretty wild and bold one. They do IPO on February 15th, 2002. They raised $70 million. Even though the market's still crashing, right? The IPO performs well. By the end of the first day, they're at about $1 billion valuation, which is about 10x last 12 months revenue in 2001.
And they were up 50%, right? That's how much it went up after they
Yep.
IPO'd.
Yep.
Yep. So
And
great performance.
worth asking again, like why did they do this? Is it pure bravery and all that stuff? I think they still had a cash issue,
Yeah.
right?
They needed the cash.
This whole time, this group, in terms of how this group was formed into who they are, this whole time they're just running out of money, running out of
Yeah.
money, running out of money. And so at this point, the combined company has about $50 million in cash.
I think it's worth noting too that during this time they had been in stop and go negotiations with eBay for a potential acquisition already when they decided to go forward with the IPO. And brilliantly, and I think this is a story maybe related to Reid Hoffman, who of course is also part of the PayPal team at this point. Apparently, one of the tactics that they used in order to prevent eBay from filing something during the quiet period of the IPO is to re-engage them in a potential acquisition process so that they would be under confidentiality and wouldn't be able to say anything about PayPal until they actually IPO'd. And
Yeah.
so kind of a brilliant tactic there.
There were a lot of interesting things that happened around their IPO that I didn't realize that, for example, as companies get in their quiet period and get up to an IPO, that's when all the lawsuits creep up out of
Yes.
nowhere because people know they can't talk about it publicly and it'll affect their IPO. And so there's some of that. There was regulatory risk throughout this whole thing because peer-to-peer payments on the internet, from digital wallets just wasn't really covered in
Yeah.
state or federal regulations. And so as they head towards their IPO, some of that regulatory risk is peeking its head. There's also, eBay had its own payments company called BillPoint. And so there's always this threat that, like, for example, eBay is going to make it all free or something like that.
Yeah.
Even though at this point PayPal is kind of free cash flow neutral, only having $50 million in cash to deal with these lawsuits and this regulatory risk, and they're still going head to head with eBay, right? Even though they merged, they still have this existential
Yeah.
competition
They're
going on.
fully dependent on them because they're built on the eBay platform, and yet they're also actively competing against them, which is pretty fascinating and dire position to be in.
So now PayPal's a public company, and we're into what I've come to really view as the second bear market of the tech and telecom bust. There really were two: one caused by interest rates and one caused by the shock of 9/11. And this as a result of there being two is going to be the second longest bear market in history since World War II. The On an annual basis, it wasn't that bad. It was 23% annualized, but it was across 31 months. Right, the average bear market's down 40%, and it's only 13 months long. So because you had two basically back-to-back bear markets, you had double the length. And so now we're into an economy that is bad. This is not normal. This is not mild. Um, and PayPal is public. They raised some more money, but they're still in this sort of feature for feature battle with eBay. And so on July 8th, 2002, really as a strategic resolution for both sides, right? Because eBay customers love PayPal, and they would revolt against eBay every time they tried to kill PayPal. But also PayPal is overly reliant on eBay. Like 2/3 of their revenue is coming from eBay, and they have this uncertainty around regulation now, and so PayPal sells the company to eBay. A lot of people at PayPal are pissed about this, right? Because this is like their mortal enemy. They've been battling, to the death for a long time. They feel like they're selling their souls to the enemy. But here's where you get, Elon, Peter, and Max's sort of first real wealth. Elon's already rich, but now Elon makes 175 million bucks from this. Peter Thiel makes 55 million bucks from this, and Max Levchin makes 34 million bucks from this. And what they go on to do with this treasure chest that they found is really like the most amazing story of the whole thing. And so now this is where you get into what people term the PayPal Mafia. And where all these guys went and what they did with this experience and wealth is a huge part of this story. Peter Thiel, he went on, he ended up using a lot of these security related innovations to found Palantir, right? Palantir is based on a lot of the security innovations from PayPal.
Yep.
He also founded Founders Fund, backed Facebook, LinkedIn, and Yahoo, right? So huge names. Everybody knows what Elon Musk went on to do: Solar City, SpaceX, Tesla, Neuralink, and importantly, OpenAI, right? And then Max Levchin has had a great history since then too. He started a couple companies that got sold. He made more money. He backed Yelp and Affirm. And there's a whole list of other people that we didn't even talk about that are involved in this.
Yes, so
Probably,
many.
probably the main one would be Reid Hoffman, right? Reid Hoffman's very, very much in this story from almost the first day.
Yep.
Founder of LinkedIn. but there's 5 or 6 other people that go on to.
Yeah, yeah. People like David Sachs, who led the product team and now, of course, has gone on to do a bunch of other stuff, including some government work right now, and the co-founders of YouTube.
So the story of PayPal is like it's so much more than the invention of peer-to-peer payments. To me, this is the story of how a couple of brilliant 20-somethings, voluntarily walked into a blazing fire where the house was about to come down in 1999. Somehow they survived, where much more experienced people died. Through the process, they were really refined and forged by just constant near failure and competition into this just absolutely extraordinary group of business people. And there's a major component that to me this is a story of refinement, right? This isn't a story of payments technology. This is a story of refinement into people that would become the best founders, investors, and builders of the next several decades up to today. Really changed the world we live in a number of ways that went way beyond payments. And so one of the things I think about a lot is what do you think refined them the most? Or do you think it was nature? Or do you think they came in, like this?
No, definitely not. I mean, it's very clear to me that these guys are extremely intelligent, all of them. And in addition to that, they are all very ambitious. They're thinking big ideas, and it's very clear in all of their backgrounds, whether you're talking about Peter, Elon, and Max, or you're talking about Reid Hoffman or David Sachs. These are all guys who have the intellectual depth to go do big things. And so the combination of those two things give you a certain element of nature or sort of innate things before PayPal. But I think there are two things that are not nature but nurture here. One is the struggle, right? So being in the trenches and surviving, right? Going through really hard things and getting through to the other side, I think turns you into somebody who, when things get hard, you can dig deep and keep going. It builds a certain confidence and endurance in you. That's number one. And then number two, I think relationships really matter. And I think the relationships that you form with other people when you are in the trenches together in survival mode, and then you get through something together and get to the other side and succeed, or at least survive, I think those relationships are like pure trust and extremely valuable. And these guys had a lot of disagreements. So it's not like they agreed on everything, and they still don't, but they still have really long lasting, very valuable relationships that go on to fuel everything that they do afterwards. Because this PayPal network, it's not, that these guys have one worldview and they're all sort of coalescing around it. Is that they all share information and they share deals and they talk to each other and they continue to refine each other and adapt. And I think that made all the difference in my mind. You find, smart people are out there, but it's rare to find smart people that have been refined and that have a network that they can go leverage to build the kinds of things that the PayPal team has gone on to build.
Yeah, I agree. There's the continuous need to innovate combined with there's just the continuous flow of new smart people, from the combination of companies and the mergers and all, and just natural life. But to me, a major lesson that probably got ingrained in them through this is just the importance of timing. Like the overlay of the PayPal story with timing is insane, right? So and they played it well.
Yeah.
In the mania part of the tech and telecom cycle in 98, 99, they focused solely on market leadership. Revenue wasn't even on the table. When in the first part of the bear market, where things were bad, but in a normal way, they focused on adding a business model and getting to profitability to where they didn't have to rely on outside capital. It could be a big boy, it could be a real business. And then when things got really bad in the economy, and there really wasn't a path forward, they really had come to kind of a loggerheads with eBay. They sold. And so I think just the lesson of I think timing is so important, and these guys learned how to play the timing or at a young age. And like you said, I think this level of intensity and competition and near failure for this long, it just changes who you are. And so these guys came out of this, ready to take on the world and have very much done so.
We said at the top that they started the company at the worst possible time, arguably, and they were playing in a market that was brutal. And so then you sort of start to question, why did they do that? And was that a dumb decision? And when you analyze this, for me, when you come in with that assumption and you start testing it, I think my view is 180 degrees in the opposite direction. I think you couldn't have founded a successful internet payments company any earlier. In fact, there were others, right? When they start Confinity and X back in 98, 99, there were others that eventually failed. And they were not peer-to-peer. They never got into eBay. And so you actually needed to let the internet develop and grow a bit to have consumers that were transacting on the internet and that were comfortable with the internet. And there was critical mass somewhere, in this case, eBay, so that then you could go take those early adopters in that market and grow with it and have tailwinds behind you as you're trying to build this network effects based platform. Without that, you couldn't have had a successful payments platform. And so in a sense, you couldn't have started this any sooner. It was the perfect time. And you just needed to go super fast and be very intense about it because your window was super short.
Mm-hmm. It begs the question, right? Where are we in AI, and like what are the businesses that are going to be possible?
It absolutely begs that question. And I also think, another key takeaway for me, and this is true for the whole series, is that despite the bust, right? We just talked about the dot-com crash and then the telecom crash and what it meant for bear markets and for the real economy. Despite all of that, if you go back and read about the vision and the promise of the internet that everybody was so excited about from 95 through 99, all of it came true. It fulfilled its promise. And so it begs the question, when you start applying that same filter to today, there are certain elements of what I might call the AI promise that at some point there will be a financial market crash and people will be disillusioned. And so we'll go through this trough of people getting disappointed. But inevitably, AI will be a world-changing technology and it will deliver on some promise. And the question is, what promise will that be? What sort of world will we be living in, 10, 15 years from now that we'll be having this same conversation, but about the AI boom instead of the dot-com boom? There's one more thing, Matt, that I was thinking about this morning, actually, right before we hopped on to record, which is that my key takeaway from this series is that there is no real science to succeeding as an operator or a founder or even an early stage investor in the context of a technology wave like this. And what I mean by that, it's almost like that Tyson saying of, everybody has a plan until you get punched in the face, right? Because I think what really matters is how you react to the punch, right? Like how do you adapt? How do you exhaust yourself solving an intractable problem and then come back the next day to do it all over again? Right? And have that endurance. How do you build trust and how do you build valuable relationships by being dependable and by caring deeply about fulfilling a certain mission above anything else? And then how do you hold on to big ambitions, big contrarian ideas when the world around you wants you to conform, right? And to seek comfort. And so to some extent, that's what I take from this series, is that there's no specific playbook. There are no tactics or universal strategy per se. There are things that we can learn from pattern recognition. But to me, the most obvious pattern of all is that you have to dive into the deep end and you have to figure it out as you go along. That is almost the only way that you can do this.
Yeah, I think all this stuff just comes back to people, right? I think there's no way to tell. I mean, we just saw this, right? Like rewind 5 years and there were all these new technologies, crypto and quantum and AI and, just blockchain, no crypto and all these different brain computer interface and like all these things. And nobody knew who was going to drive the next technology revolution just a couple of years ago. Now it's very obvious, right? AI has emerged as the sort of next thing. And so I don't think you can ever know which technology is going to end up winning. But to me, it's just all about the people.
Yeah, it's very path dependent, right? It's people dependent.
Yeah. All right. So thank you for listening to our Tech and Telecom series. If you enjoyed this, the best way to help us is to share with anyone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. And of course, tune in for our next series in a couple of weeks. Thanks.
All right, Matt. Talk to you soon.